For decades, the golden rule of inheritance taxation has been the step-up in basis. When you inherited your parents' home, stock portfolio, or rental property, the tax code automatically reset the cost basis to the market value on the date of death. That meant all the unrealized gains, sometimes tens or hundreds of thousands of dollars, vanished from the tax equation. You could sell immediately without owing a dime in capital gains because the IRS treated your inheritance as if you had bought it at that new, higher value. It felt like a bonus for the generations before you. The lead-up years of booming home prices or bull market rallies never triggered a tax bill in your hands. Under the old rules, everyone assumed that step-up was an ironclad entitlement baked into the system as part of the federal estate tax exclusion. Even if the estate itself exceeded the exemption threshold, heirs still benefited from a step-up to that exemption. Planning revolved around leveraging that basis adjustment. Parents would hold assets until death rather than selling during their lifetimes, ensuring heirs received a clean slate for future gains. But in 2025, that certainty is gone. The IRS has quietly replaced full, across-the-board step-up with a carryover basis regime capped by a $3.5 million per decedent allowance. That means only the first $3.5 million in value across all inherited assets gets stepped up. Any value above that retains the original purchase price. So, if your family home, passed down for generations, is worth $5 million, only $3.5 million of its built-in gain is forgiven. The remaining $1.5 million in appreciation carries the decedent's basis and becomes immediately taxable when you sell. It's a seismic shift in the tax landscape. What was once a universally celebrated perk, free capital gains elimination at death, is now limited, complex, and time-sensitive. And since the rule took effect without fanfare, many families are blissfully unaware until they face a massive, unexpected tax bill. Understanding that the full step-up has been traded for a cap carryover is the first critical step in protecting your inheritance from a tax surprise you never saw coming. Here's how the new carryover basis mechanics actually play out, and why they leave heirs on the hook for gains they never realized they owed. First, you identify the fair market value of each inherited asset on the decedent's date of death. Homes, stocks, collectibles, everything. The first $3.5 million of combined value across all those assets steps up to that date of death value, tax-free. But any portion of that aggregate value beyond $3.5 million keeps the decedent's original cost basis, meaning you inherit not just the asset, but its full history of appreciation above the cap. So, if your parents left you a $6 million portfolio of stocks they'd bought for $1 million decades ago, only $3.5 million of that $5 million gain is forgiven. The remaining $1.5 million gain still carries their original basis. Now, suppose you decide to sell immediately rather than owing zero tax, as you once would have. You must report that $1.5 million as a capital gain, exposing you to federal and potentially state taxes at rates up to 23.8% or more. This isn't a per asset carve-out, it's a per decedent cap. If there are multiple heirs splitting that $6 million portfolio, they must apportion the stepped-up basis collectively, often in equal shares, so coordinating with siblings or co-beneficiaries becomes crucial. If one sibling wants to keep the family home while another takes stocks, they must allocate the $3.5 million exemption strategically to minimize the overall tax burden. And failing to file an estate basis election on time, within 9 months of death, means you forfeit the entire allowance. Complicating matters further, many heirs assume that mutual fund dividends and reinvested distributions automatically adjust basis, but under carryover rules, every purchase date and reinvestment in a brokerage account retains its original basis until the overall cap is applied. Tax software and brokerage statements won't flag these nuances. You'll need meticulous records, professional appraisals for real estate, and possibly a specialized accountant to trace cost basis across decades of trades. In short, carryover basis transforms what was once an automatic free pass into a delicate dance of numbers, deadlines, and elections where missteps can trigger six-figure tax bills. It's no longer enough to know the value of your inheritance. You must master the basis math and file the right forms promptly, or risk paying taxes on gains you never expected to face. Inherited brokerage accounts carry a hidden trap. When carryover basis replaces full step-up, your shares, ETFs, and bond holdings can saddle you with significant tax liabilities, and few heirs realize it until they sell. Under the old stepped-up basis, you could liquidate a stock position worth $500,000 with an original cost basis of $50,000 and owe zero capital gains tax. Today, only the first $3.5 million in aggregate assets enjoys the reset. Any value above that keeps the decedent's basis, triggering a taxable gain on sale. But here's where it gets worse. Most brokerage statements aren't designed for carryover basis. They report the original purchase dates and costs tied to your parents. But when hundreds of trades over decades feed into a single position, breaking out which shares fall above or below the $3.5 million cap becomes a forensic accounting nightmare. If your parents' account held 10,000 shares of a blue-chip stock purchased incrementally over 30 years, you now must determine exactly which tons of shares get the stepped-up basis and which carry the historical cost. Few retail brokerages support this level of basis tracing. Many simply lump the entire lot into a single cost basis figure. That leaves you guessing, or worse, relying on incomplete data that pushes you into paying either more tax than needed or facing an IRS audit for underreporting. Then there's the bond portfolio you inherited: municipal bonds, corporate notes, or government debt. Even under full step-up, bond accretion and amortization rules require detailed tracking. Under carryover, every embedded gain or loss in bond principal that exceeds the cap retains the original acquisition cost. Since bond basis adjustments for premium or discount aren't always reflected in account statements, you could face unexpected taxable gains at the time of sale or maturity. And watch out for wash sale complications. If you inherited a position with a loss carryover or unusual wash sale flags, say, your parents sold shares at a loss within 30 days before death, those adjustments carry through to the heir. Instead of wiping out that loss on a new purchase, you might inherit the disallowed loss, unable to claim it, while still having to use the old basis above the cap for gains. Finally, ADR only or international holdings add another wrinkle. American depository receipts for foreign equities sometimes have multiple layers of foreign withholding taxes and currency fluctuations. Under carryover basis, calculating the adjusted cost for both gain and loss sides can require tracking FX rates on every dividend reinvestment and corporate action. One tiny misstep, a missing FX rate or unreported drip transaction, could magnify your tax bill by thousands. In 2025, brokerage accounts have become tax minefields for heirs. Carryover basis rules, incomplete statements, wash sale quirks, and FX complexities all converge to create kaleidoscopic reporting challenges. Unless you enlist a tax professional who specializes in inherited securities and demand detailed accounting from your custodian, you risk paying more tax than necessary or getting blindsided by an IRS notice long after the account has been drained. Understanding these brokerage pitfalls is essential to preserving your legacy rather than inadvertently eroding it with unexpected tax liabilities. When you inherit a traditional IRA or 401k today, what once felt like a tax-deferred treasure can turn into a costly pitfall under the new rules, especially with carryover basis and the secure 2.0 distribution mandates. Before, beneficiaries could stretch required minimum distributions, RMDs, over their lifetimes, smoothing out tax impacts. Now, most non-spousal heirs must fully distribute the account within 10 years of the decedent's death, with no step-up in basis beyond the $3.5 million cap. That compressed window forces you to recognize potentially massive ordinary income amounts all at once, often pushing you into far higher tax brackets than you'd ever anticipated. Consider inheriting a $2 million IRA from a parent. If you take equal withdrawals over 10 years, that's $200,000 each year added to your taxable income. For many retirees, that bump can move you from the 24% bracket into 35% or even 37%, not counting state income taxes. Unlike capital gains, where only the gain above basis is taxed, IRA distributions are taxed at your full marginal rate, and there's no basis relief for inherited accounts. The result, you could owe $70,000 or more in federal tax each year on that inherited account alone, potentially negating any expected benefit of the legacy. Worse yet, if you need cash earlier, say, to cover medical expenses, you might be forced to accelerate distributions into an even shorter time frame, compounding the tax pain. Roth IRAs can help, since qualified withdrawals are tax-free, but the conversion rules don't apply post-inheritance. You can't convert an inherited traditional IRA into a Roth without triggering taxable income immediately. And if your inheritance pushes you into IRMA territory, you'll also face higher Medicare premiums for years to come. Then there's the pecking order. If you split inherited IRAs with siblings, you must set up separate accounts by December 31st of the year after the decedent's death. Miss that deadline, and the IRS treats the entire balance as distributed in one lump sum, subject to 100% penalty if you're under 59.5, plus ordinary income tax. Even spousal rollovers aren't immune. A surviving spouse must elect to treat the inherited IRA as their own by year-end or face the same 10-year rule and potential missteps. In the era of Secure 2.0 and capped basis step-ups, inherited retirement plans require surgical precision in timing, beneficiary designations, and tax bracket management. One missed deadline, one misunderstood rule, and your inheritance morphs from a tax-deferred blessing into a multi-year tax liability you never saw coming. If you're expecting an IRA or 401k windfall, you need professional guidance now, because that 10-year countdown doesn't wait, and neither does Uncle Sam. Trusts are often hailed as the ultimate tool for estate planning, but in 2025's carryover basis world, they can become a labyrinth of hidden tax traps that strip heirs of their basis adjustments entirely. Take a simple revocable living trust. Assets transferred at death pass through probate avoidance, but the trust itself offers no step up beyond the $3.5 million cap. Worse, if the trust holds diverse assets, real estate, art collections, stock positions, the collective value counts against that cap in one single pot, leaving no room for strategic basis allocation among beneficiaries. Then there are grantor trusts, where the decedent continues to pay income tax on trust earnings during life. While this can reduce estate tax liability, it creates a perilous carryover scenario. The grantor's original basis in the trust assets carries through to the beneficiaries in full, subject to the cap. Imagine a grantor trust funded decades ago with commercial property that skyrocketed in value. Under the old step-up system, an heir selling that property would enjoy zero capital gains. Today, unless the property's adjusted value falls beneath the $3.5 million threshold, heirs inherit the full original cost basis, potentially millions in taxable gains. QTIP trusts, often used to provide for a surviving spouse while preserving remainder interest for children, carry their own hidden pitfalls. Although QTIP assets qualify for the marital deduction, they receive only a partial step-up at the first spouse's death and no further adjustment at the second spouse's passing. That means a single basis adjustment at the first death, limited by the cap, followed by a second inheritance event where new gains beyond the original cap are fully taxable to the remainder beneficiaries. Families who assumed their double trust strategy would reset basis twice are now blindsided by surprise tax bills after the second generation inherits. Finally, complex unitrusts and dynasty trusts can trigger phantom income or premature gain recognition. If a trust sells appreciated assets to fund mandatory distributions, the trust itself pays capital gains taxes, but the grantor's carryover basis, capped as before, still applies against beneficiaries' inherited interests. The net result? The trust's tax hit reduces the available distributions, and heirs face taxable gains on distributions measured against the original grantor's cost basis, leaving them double taxed on the same appreciation. Navigating these trust-based inheritances demands a forensic approach, mapping each asset's cost history, modeling the aggregate cap effect, and possibly unwinding or decanting troubled trusts before death. And with carryover basis rules in place, every sentence of your trust document and every election you make at death must be meticulously reviewed. Otherwise, you risk turning your carefully crafted legacy plan into a tax minefield that detonates in heirs' hands. With the carryover basis cap looming, proactive planning becomes your most powerful weapon to shield inheritances from this stealth tax. First, consider accelerated gifting. By transferring assets before death, up to the annual exclusion amount, $18,000 per recipient in 2025, you remove future appreciation from the estate's tax calculation. Even though gifts don't receive a stepped-up basis, they can lower the estate's overall value below the $3.5 million cap, preserving full step-up for the remaining assets. Next, family limited partnerships, FLPs, or LLCs can introduce valuation discounts for minority interests, effectively reducing the apparent value of transferred assets. Parents can gift partnership interests rather than underlying assets, shrinking the estate's real estate or business holdings for basis purposes. Properly structured, this maneuver allows heirs to benefit from basis adjustments on a smaller pool of assets, maximizing the cap's impact. Qualified Personal Residence Trusts, QPRTs, offer another route. You transfer your home into a trust, retaining the right to live there for a term, after which it passes to heirs at a reduced taxable value. Because the IRS discounts the residence's value by your retained interest, you strip future appreciation out of the estate, and any basis step-up applies to the lowered value, amplifying the cap. If your home's worth explodes beyond expectation, you've secured basis relief on the discounted figure, potentially saving millions in capital gains taxes down the line. For retirement accounts, pre-death Roth conversions can be a game changer. By converting traditional IRAs to Roth IRAs over several years, while you're still alive and in lower tax brackets, you pay income tax on the conversions now, but heirs inherit the Roth tax-free, with no required basis step-up. This sidesteps the cap entirely and shields the IRA value from post-death tax cliffs. Finally, estate basis elections must be filed meticulously. Executors have a 9-month window after death to elect carryover basis and allocate the $3.5 million allowance. Working with a specialized estate tax attorney and CPA, you can strategically assign basis to high-gain assets, homes, stocks, art, while leaving low-gain items unaffected. Some states offer beneficiary disclaimers, allowing heirs to refuse part of an inheritance, pushing assets to contingent beneficiaries or trusts better positioned to absorb basis. These advanced techniques require early action, often years in advance of death, and flawless execution of complex legal documents. But in the new IRS landscape, they can mean the difference between a tax-free inheritance and a headline-grabbing capital gains bill. If you care about preserving your legacy and protecting your heirs from a rule they never saw coming, now is the time to meet with your advisors, revisit your estate plan, and deploy these strategies before the clock on unexpected taxes starts ticking. The shift from a full step-up basis to a capped carryover regime isn't just a technical tweak. It fundamentally changes the inheritance landscape, transforming what once felt like a seamless tax break into a complex puzzle of limits, elections, and deadlines. If you followed along, you know that the old certainty automatic basis resets on every inherited asset has been replaced by a $3.5 million allowance, a per-decedent cap that forces heirs to absorb the decedent's original gains above that threshold. You've seen how carryover basis upends every asset class. Homes, brokerage accounts, retirement plans, and trusts all carry hidden liabilities that can translate into six-figure tax bills if you don't plan. But knowledge alone isn't enough. The real takeaway is urgency. This rule is here now, and the clock starts ticking the moment a loved one passes. Executors have just 9 months to file the correct elections. Beneficiaries must coordinate to allocate basis across multiple heirs. Families need to reconcile decades of cost records for stocks and bonds, and sophisticated vehicles like FLPs, QPRTs, and Roth conversions must be in place well in advance of death. A missed deadline or flawed calculation isn't a minor slip. It can void your planning strategy and leave heirs with tax obligations they never anticipated or budgeted for. Your action plan is clear. Gather your team, estate attorney, CPA, financial advisor, and conduct an immediate audit of your estate plan. Identify assets that will likely exceed the carryover cap. Map out your gifting, trust structures, and Roth conversion timeline so that appreciation outside the cap is minimized or shifted away before the rule bites. If you already have active trusts, review their terms to ensure they don't inadvertently block you from basis elections or force unhelpful distributions. For retirement accounts, weigh the benefits of pre-death Roth conversions against post-death distribution mandates. And for highly appreciated real estate or collectibles, consider QPRTs or family partnerships to lock in discounted values and maximize basis relief. In 2025, your inheritance is no longer a passive benefit, it's a tax problem to solve. The good news is these strategies work if deployed thoughtfully and early. The alternative is a surprise tax liability that can erode the legacy you intended to leave. So, do more than watch this video, make it a catalyst for action. Schedule that estate planning review, demand the right elections, and commit to the deadlines you can't afford to miss. Because in this new IRS world, the greatest security you can leave your heirs isn't just assets. It's a plan airtight enough to withstand this unexpected tax twist.